And welcome. This is the Investor Coaching Show. Paul Winkler. Coaching investors, teaching about investing markets, how they work, because it is the investor that has knowledge about how markets work, where returns come from, and just is aware of what's going on around them and what they're doing, why they're doing it, and what to expect and all that. Well, those are the ones that end up being successful, as I often talk about. If I know what to, especially what to expect, that is a huge, huge issue for investors. You know, anytime you go into something, go, I don't know what to expect. But let's say if you walk in really optimistic, and you go, I think this is going to be just wonderful. And I often use the example of marriage. It's just going to be bliss every day. And then all of a sudden, you actually get into the marriage, and it's not bliss every day. It's a wake-up call, and then you end up disgruntled and unhappy. You go into a job. I think it's going to be the best job ever. And then all of a sudden, you have a bad day, and you're like, oh, man, I can't wait to get out of here. So optimism has its place, but, being realistic and realizing that things are not always going to go well, that's a really important part of it. But Wall Street sells us on the idea of everything's going to be great. We've got this manager, and this manager has a great track record. They're really, really great at, telling us where markets are going to go next and what's going to happen next. And you ought to invest with us. Well, it sells people, but the problem is it doesn't keep them around. And I've always been of the opinion, being honest with people, you just tell them the stinking truth. You tell them the stinking truth, and you know what? You might have an investor for life. But you lie to them and tell them that it's going to be great and it's going to be always wonderful and we have these great abilities that you just simply don't have, then guess what? You're not going to have a customer for life. And that, I think, is just the key to success, that the investment industry, if they'd ever figured out, they might have something on their hands. But, what they do is same stuff, different day, all over the place. And the media is really good at this, really shaking people up. But that brings me to this topic, because this past week, we actually hit an anniversary. Anybody know what that anniversary was? Well, if you're out there and you're yelling at this screen that it was the 2-year anniversary, or if you're not watching on a screen, you happen, because this is actually, we got the video and the audio going here. If you're listening, you might go that it's, the 2-year anniversary of the bottom of the downturn at COVID, right? And this is, we were doing workshops and we were doing, I remember bringing in my whole staff, and we had this new room that we were actually going to be doing all of our, our radio shows in, and I brought everybody in. And we sort of socially distanced. We weren't really that great at socially distancing. We really didn't. We just didn't do much of it. But we kind of had, I was in one room and everybody else, they're all kind of just spread out in other areas, because we didn't really have the setup to have everybody, all separated from each other. But, we had these conversations about what's going on. What do we need to think about this? How are things going? What are happening in markets? And it was a scary time for a lot of investors. That one little statistic that we had seen back then, March of 2020, it was something like 30% of investors, and they had various age brackets, like 55 and 60 and 65, had pulled their money out of stocks completely during that period of time. And just hearing all of the terrible things that were going to happen, how everything was going to close down, who could blame people for getting scared? Now, that is exactly what Market Watch actually talked about. They had this article, and it was the stock market hit its COVID low 2 years ago today. Here's how the performance stacks up. It's the second anniversary, and this is past Wednesday, of the lows set in the U.S. stock market plunge triggered by the COVID-19 pandemic, 2020. stocks have stumbled in 2022. Some areas are actually up, so actually I would disagree with that. But there are areas that are actually up, but a lot of people don't own them because they're areas that wouldn't be on a radar screen for an American investor. And it says when they're rising, but here's basically what happened. Even though they had and this is the only thing that media only looks at the S&P 500. Let's face it, it's like nothing else exists for them. But we're just going to go with it. S&P 500 is actually has risen 101% from that close, back 2 years ago. And it's true, you got a 100% return. That's huge if you think about that. Now, I went and looked at the data just to go, okay, what other areas? Because, if you're diversified, you shouldn't just have everything in the S&P 500. Small U.S. value stocks, get this, 169% 2-year return. Microcap stocks up almost 140%. Small caps 133%. Large value stocks over 110%. International large value, it was 111%. And so, you look at that and go, well, the U.S. large, which is what everybody focuses on, is one of the lower performing areas over that whole time. So, I started thinking about this, people bailing out and what we were doing to try to help investors not do this. Because a lot of times when markets are down, that's when I get people, Paul, what do you think is really going to happen this time? And some people just lose faith altogether and they just get mad at me. Like I'm in charge of the markets or something like that. But, and especially when I do a video that's optimistic, it's just like, I remember somebody calling, Pollyanna. And, yeah, you're just Pollyanna. And I just go, come on, really? No, this is what I'm supposed to do. It's, making sure that you don't shoot yourself in the foot when markets are down. So what I did is I looked back at my archives, my video archives on my website, and you actually go back there and look at this yourself. It's paulwinkler.com, and you go through the videos, and you can actually tool through and look at past videos that I've done. And you have to go back a lot of videos to find back in March of 2020. But the one workshop that I had done, which ended up being like really, really popular, there was something, I think at Facebook, at 60, 70,000 views of it. But it was the workshop, Too Old for Downturns. And it was about how, oh my goodness, I'm too old for this. I don't have time to recover from a stock market downturn. And, if this is just too much, I just got to go to the sidelines. I can't do this anymore. And there were people that were saying that. And what I did is I did a video on that, and I had people that would come in and go, Paul, I'm just, and luckily not our clients. Our clients, people ask me all the time, are your clients panicking? And, and I'll say, well, no. You educate them really, really well, and they don't panic when what they know will likely happen or expect to happen, because I basically prime them for it. When it happens, it's not this big shock. And so, what are we doing? Are we making any changes? Yeah, well, we're always making changes. We're rebalancing portfolios in the U.S. on a daily basis for our clients, and we're rebalancing quarterly between, international, U.S. and fixed income. And yeah, there's constantly stuff going on. But panicking, no, that's not what's going on. So what happened is that I did this video, and I'm walking through, it's different this time. Man, this is terrible. It's awful. And I said, well, when we went through the Depression, it was different. We had never been, if as an investor, you've probably never seen something like that before if you were an investor in the late 20s, early 30s. If you were in the late 30s, let's go late 20s, first of all, we look at that in the Depression, and it was, the roaring 20s were phenomenal. So an investor that had been investing during the roaring 20s, or, when the 30s came along, and they heard what was happening regarding, the Fed was screwing up. You had, tariffs that were increased as a result of it to try to protect, they called it protectionism, protect the countries, so that we could make sure that we kept the jobs here. And then we had deflation, prices going down, but we didn't have a Congress that had the will to let companies actually raise or change their reduce the pay of people, because hey, if we reduce the pay, that's not good. People don't like to see their paychecks go down. When in reality, because of deflation, their paychecks had greater purchasing power, so they really wouldn't have been hurt by it. But literally, our legislators were saying, hey, let's do this. Let's make sure that they don't reduce the people's paychecks because they'll get mad at us in Congress. And let's make sure that we have these controls in place. And that, of course, made things even worse, because that's what Washington often does, make stuff worse. And then we have the late 1930s. We get into World War II. I've never been in something like that. We had World War I, but this World War II, we got technologies that are really, really devastating now. And wow, this is really, really bad. And then you have the Cuban Missile Crisis. We have literally nukes right off our shores in Florida. And then you've got the 70s oil crisis. We don't have oil. And, all of that, all the stuff. And it's always something different is my point. So I did this workshop talking about too old for downturns, and I literally put that workshop out. Remember, the 23rd was the market low, right? I actually did that workshop and published it on the 20th, literally 3 days before. Then I did another video a couple days later because, it's not enough to do a long video. Some people just won't watch the longer videos, so I'll do little short videos as well on my website. And I did one called Half Empty or Half Full. And it was this thing I was talking about, Mark Short, this guy, was talking about statistics about treatment plans and that there were promising treatment plans out there. And I was looking for anything I could to help people realize that the world wasn't ending, that there may be some promising things on the horizon. And I went back and watched the video, and one of the things that I actually talked about, and there's something I talk about quite frequently when you have market downturns, which is I will tell people I look at the price of stocks compared to their book values, their assets minus liabilities. And what I mentioned in that particular video is I said I'd never seen prices this low. You had some areas of the market selling for 50 cents on the dollar, price to book. And the point I was trying to make was that could it go lower? And I did say this. I said, could it go lower? Yeah, I guess it can. You never know how low people are willing to sell their stocks for. But it's pretty stinking low. And I said small values in U.S. stocks selling for 70 cents on the dollar is what I said in the video. And that was the area that, since then is up almost 170%. And I published that video on March 22nd. Well, remember, March 23rd was the market low. And, we were kidding about that in the office here. It's like, whoa, that's pretty forward looking. I have no clue. I had no clue that it was going to be the market bottom. No way of knowing that. But that is how I look at things. I always look for, especially when people get really, really pessimistic, I'm looking for something positive. And the reason is because typically that's being completely ignored. We have a part of our brain, the inner part of our brain, that is the fear center, the amygdala, and that actually goes into hyperdrive when things become threatening. And when that becomes engaged, many times a lot of times what happens, the frontal lobe of our brain, which is the conscious, cognitive, rational thought process machine in our brain shuts down. And it's overridden because we're in survival mode. And for an investor, that is really dangerous when you're in that survival mode, because that's when you take action that ends up really hurting you long run. And that's exactly what a lot of people did. They went and took action, and it was the wrong action based on these numbers. So this is why I slow down and go, okay, I get it. It's scary. And when you do that with somebody, I get it. It's scary. What that has a tendency to do is it tends to calm down that part of your mind that is in survival mode. And then it allows them to re-engage the part of their brain that is logic-driven, rational, and the thought processes become, okay, I knew this could happen, and I get it. It makes sense. Oh, wow, 50 cents on the dollar. Okay, yeah, maybe I don't need to do anything right now. Maybe I just go, if it helps, don't look at the statements during those periods of time. And then just take a deep breath, go out, walk in the grass or something in your yard, and just go, you know what? This too shall pass. And that's basically what I said. There are people that are glass half full. There are people that are glass half empty. And history shows us that the glass half empty people usually end up being wrong. Because as humans, we find a way forward. We find a way to solve the problems that we have and come out on the other side better, stronger, and hopefully more resilient. And that's exactly what happened 2 years ago, this past Wednesday.